don't even know what it costs. I hit the ground then it go off. Yeah, hit the ground then it go off. Yeah, I can't take no loss. Yeah, I don't even know what it costs. Yeah, I hit the ground then it go off. Yeah, hit the ground then it go off. Yeah, run it. Ooh, I really feel it's my time. Think it's my year.
All right. Good morning, everybody. Happy Thursday. This is the morning show here on Stock Market TV. Hunter Israel, JC Parets. Got Alfonso here. What else do we got today? It's Thursday, so we got Sean on the show and a new guest. I love my new guest, Steve Reitmeister, who was with us a little bit in Chicago a few weeks ago. He'll be on the show at 9. We'll have Mr. Glick stop by. And the theme of the day, I guess, is what? Like the dash for trash? That's my theme of the day, dash for trash. I mean, yesterday at least, and probably again today, is just they're buying up all the crap, right? All the SPACs, all the unprofitable, beaten down tech, everything. Just buy it because why the heck not? So that's my theme of the day. What up, chat? How we doing? Let's see what JC's theme of the day is. Let's see what his theme was from the conference call last night. Here we go.
All right, Spencer Israel, how are we doing today?
Great.
I gotta tell you, I'm feeling pretty good. It was a long day yesterday. We had a lot. We covered so much yesterday between the Momentum Mastermind and the monthly charts conference call. You didn't think I could do it?
No, I doubted you.
It actually went really well. So we've been doing this 12-week mastermind. This is week 2. It's all about momentum. Wait till you see the guest that we have on. And yesterday was all about how we use momentum, specifically me, even internally. And what I try to do, Spencer, also is kind of reiterate that just because I do things in a certain way doesn't mean that everybody should do it that way. And I try to kind of give some ideas as to, where you can go and look for more information to manipulate these indicators and change things around and get creative. Just because I don't do that doesn't mean that you shouldn't. I have in the past, and I probably will again in the future. I'm just not doing it right now because I'm using these tools in a specific way, and you might want to use them in different ways, and that's cool. So I try to do a good job of that. Like just because we do it this way doesn't mean it's the only way to do it, right? I thought that was good.
Yeah. You did good. I admittedly I missed 100. Very rare for me, but I missed 100% of your conference call.
It was a holiday yesterday for you.
Yes, it was a Jewish holiday, so I was out.
Fair.
I was out doing braving the rush hour traffic to get somewhere. But
throw up slide 3 quick. I think it's worth mentioning this because this was such an important topic that we discussed in week 1 of the mastermind. And this was the conversation that we had with Chris Kane. So Chris Kane, U.S. quantitative strategist at Bloomberg Intelligence, more specifically. He's the guy that gets to play with all the toys at Bloomberg. Like, that's literally his job. I ask him, I'm like, is your job literally just to play with toys? And he like chuckles and he's like, no, but kind of, like he gets all the latest, tech. He's the one building a lot of it also. So keep that in mind. And the conversation was all about diversification. And most investors are just not diversified. Just because you own large caps and small caps and international and emerging markets and you have a value fund, like that doesn't mean you're diversified. That just means you own a lot of stocks. So the conversation is really about how powerful the compounding becomes when you lower portfolio volatility. And the best way to lower portfolio volatility is to have a series of different strategies that are uncorrelated to one another. The holy grail, according to Ray Dalio, is 15 strategies. 15. Now, Chris and I both agree it's a little aggressive. Aggressive. We're not all Ray Dalio. We don't have all those resources. We don't have all that money. 15's a little much. I think him and I both agree, actually, that the right number is about 3 to 5. Because even after 5, the law of diminishing returns plays in, where if you have a 6th strategy, a 7th, an 8th, a 9th, like the benefits that you're getting from each additional strategy are less and less with each one, where it's almost negligible at the end. So I think 3 to 5 strategies, and they don't have to be completely different assets. One strategy could be a short-term strategy and one could be a longer-term strategy. That's enough. One could be mean reverting in nature. One could be trending in nature. You know, you can include commodities and a bond ETF strategy, for example. These are all different ways to really increase your diversification, like in a real way. And when you do that properly, and it's not that hard, a lot of us are doing it already, and we're not even thinking about it. You know, once you get 3-4 different strategies, you're not lowering the forward returns, right? So you're not
Right.
losing out on profits. What you're doing is you're minimizing that portfolio volatility. And by minimizing that portfolio volatility, when you see the math, the returns compound faster over time because you're avoiding that portfolio volatility. So just amazing conversation. He's basically saying the same things that I'm generally saying. He just says it so much better than I do, right? Like when when you include math and you could just like point to the data, like we do in technical analysis, right? You can just point to the data. By the way, he's a CMT also, and Charles Dow Award winner. So he's the guy, Chris Kane. So guys, check out the 12-week mastermind. This was one of our lab sessions for week 1, really setting the stage for the next 12 weeks. This week was momentum, but this conversation really stood out. Would you? How do you feel about that, Spencer? You don't really talk about
No,
diversification much. Do you agree?
this was like, I know this was the first the Chris Kane video was in line with like the theme of the first week. That was last week's theme. And I was thinking, man, this might be my favorite one of the course, and it was only the first one. And I was thinking, man, I can already tell this is going to be one of, if not my favorite class, just because a lot of what he said spoke to me. Even though I'm not going to do like all the things he said, but just because you're not going to do it doesn't mean it's not valuable, right? Because it's good to get sort of that perspective on it. So,
and then just to understand, right? It's more like understanding, like the concepts, right?
Exactly.
And then you apply it, how you see fit for
Yeah,
your own selfish needs.
and just the concept of when we talk about things like opportunity cost, what I don't think about as much is the disruption of the compounding, right? That's what I don't think about as much. And it was good to hear him talk about like that, and something that you have to think about that when you're when thinking about like what to do is.
Yeah, I agree. Great concepts.
Yeah,
All right.
yeah. Cool.
That was great. What do you say? What do we say we do a little state of the markets, eh?
Yeah, sure. We have things to talk about, right? I think.
Yes,
I don't know.
Always. All right, ladies and gentlemen, we've got the Dow futures down 0.25%, 42,400, down 100 points on the day. S&P futures down 8 handles. It's 15 basis points, 57.50 for the S&P. Nasdaq 100 down almost 0.33%, just under 20,000, down 50 handles. 30-year bond futures down 0.25%, down to 124, with crude oil up another 2% today, 71.5 for crude oil. Copper down over 2%, back down to 454. Gold flat on the day, 26.66. Silver down 0.33%, 31.80, with the volatility index up, pushing 20 again for the volatility index, still hanging around that 19 level. And then over in funny money land, we've got Bitcoin flat on the day, 60,500. Ethereum down 0.5%, 23.50. Solana down 3% today, 135. Solana getting hammered. Binance 540, down 0.2%. Really struggle city over there. With the total crypto market cap, Spencer Israel continues to fall at 2.05 trillion. Bitcoin dominance, on the other hand, continues to rise, 58% for the Bitcoin dominance. In other words, the percentage that Bitcoin represents for the entire crypto space is now above 58%. So very dominant there. What stands out from this morning's futures, Mr. Spencer?
Yeah, I was looking at China, right? Hong Kong specifically, not Shanghai, right? Hong Kong, down 1.5%. Sticks out to me. What else sticks out to me? Not much, honestly. I mean, we just had some jobless claims come in. Don't really care about that.
Look at my mug. This is my Ireland mug.
Oh, nice.
They say Cubans are the Irish of the Caribbean.
I think that's an insult.
I don't think it is. I take that as a compliment.
Okay.
Why would that be an insult? What's your beef with
I
the
don't
Irish?
know. I'm neither Irish nor Cuban, so I don't know. But I feel like just context clues. It's a no. Is it, maybe I'm way off. I could just be way off.
I think it means that we're nice. I think it means that we like to party.
Okay.
Cubans got better food than the Irish, with all due respect.
Yeah.
You know, Ireland not known for their cuisine. Dublin's got some good eats, but you know, not known for their cuisine. Good for other things. Freaking love Ireland, man. What a great place. I want to take my kids there and go see castles. There's just like medieval castles everywhere. It's fantastic.
Right.
Um,
All right. Well, let's talk about what were like the themes, since I wasn't even there. What were like the themes of your call last night?
well, I mean, somebody in the chat was already chiming in. So many biotech stocks in the monthly conference call. Like, if that's not an indicator of what's happening, the fact that we had so many biotechnology stocks to discuss. Hello, rotation. Throw up slide 3, please, Spencer. Because this one, to me, I feel like is not getting a lot of play. You see it getting a lot of play?
The equal weight stuff? No.
The fact that the S&P 500 and the Nasdaq 100 both closed at the highest levels in history for the month on both a market cap weighted basis and on an equally weighted basis.
Yeah, well, I get most of my sentiment from Patrick's last chart report.
Well, that's probably not the best place to get sentiment, because there's a lot of like smart people
Yeah.
that Patrick is quoting in the chart report. So the idea is to not get the sentiment from not so much the smartest, cleverest individuals, but
I should rephrase. I get my smart sentiment from the chart report. I get my dumb sentiment from Reddit, and no one's talking about the equal weight stuff. So
listen, if you want your dumb sentiment, turn on the TV, turn on the radio, read articles written by journalists. Like, you want dumb sentiment, that's where you want to go. If you want smart opinions and like thoughts and perspective, the chart report is going to get you done there, because Patrick is specifically looking for those things, right? We're not quoting journalists, we're quoting portfolio managers, right? What about the new slide 4? Throw up the new slide 4. This one I think is not getting any play at all. This is a big one, and this is the continued underperformance from technology. Again, Spencer, is this
no, we're talking about
you
this.
see anybody talking about the continued underperformance from technology?
No, we talked about this yesterday. No,
I mean, just nobody's talking
changed.
about it. Small cap tech is somehow down this year. Large cap tech is underperforming massively. Large cap tech was actually down in the last quarter for Q3. Tech was down despite financials up double digits, consumer discretionary up double digits, industrials up double digits, S&P, Nasdaq, Dow all exceeding your average returns, regardless of September or not, just massively outperforming. And technology couldn't even go up in the third quarter, the entire third quarter, right? I just don't see it getting a lot of play at all here. I got another good one for you. This is the new slide 5. This one brought to us by Kevin Gordon.
Ooh.
Kevin Gordon is the director, senior investment strategist at Charles Schwab.
Yeah, he was on the show a few months back.
Kevin Gordon putting out some good work out there. Big shout to Kevin. He's pointing at the percentage of S&P 500 stocks that are outperforming the S&P 500 index itself. Now 70% of stocks have been outperforming the S&P 500. I'm old enough to remember, Spencer. Old enough to remember when these people were lying to you about only 7 stocks going up. Remember that?
What does it say that the like amplitude of these has gone way up the last 4 years? Does that mean anything?
Ooh, SAT word there, Spencer. I see you, dog. Amplitude. Okay.
Or the range, whatever the range.
No, you used the proper nomenclature. That's very impressive.
Right. Thank you. So does that mean anything, or or am I just overthinking it?
You know what it is? You know what the consistency, Spencer, of what you saw 25 years ago and what you're seeing now? You know what it is? It's the underperformance of technology, right? So when you get that underperformance of technology, you're going to get wider swings because technology represents such a large percentage of the overall market.
Okay,
So in an
okay.
environment,
So that's really what it is. It's that technology is so big, it's bigger than it's ever been, that the movement, the performance of that will dictate this chart, really.
I
So,
mean, without going in and doing the math, just using some common sense, I think, yeah, sure. I mean, you're seeing these massive swings in an environment that technology is massively underperforming. On here, we're just looking at large caps.
okay. So anyway, bottom line is more companies in the S&P, which caveat, the S&P is not the whole market, but regardless, more companies in the S&P are beating the S&P than at any point since 1993.
Right, since the data has been calculated, which, yeah, S&P goes
That,
back further, but
that can't possibly be bearish, I don't think.
well, it's not so much that it's bearish or bullish, right? I mean, I wouldn't take that as bearish, to your point, agreed. But I think it's bigger than that. I think it's just understanding why this is happening. And I think it gets back to the earlier point that technology is just a massive underperformer and technology is such a large weighting, right? The technology actually hit new 52-week lows relative to the NASDAQ last month, for example. New 52-week lows for tech relative to the NASDAQ.
The NASDAQ 100?
Yes.
But you're measuring a tech index against a tech index. So
I'm measuring technology relative to an index that's 50% technology.
right. So tech index against the tech index. So,
well, a pure tech index versus an index that's only half tech.
Yeah, but
right.
But
and it's hitting new 52-week lows. Again, all that means is that technology is underperforming, and that's where this data comes from. Why do you think 70% of stocks are outperforming? It's because tech's underperforming. And if it was a situation where tech was doing well, it wouldn't be bearish that a lot of stocks have a hard time keeping up with the S&P 500 that's being driven by technology. It's not necessarily a bad thing that a lot of stocks are underperforming if technology is just doing great. There's nothing wrong with that. Just like I don't want to overthink the bullish implications of technology underperforming. Like, I think it's just another way to say the exact same thing.
Yeah.
It's a bull market, and tech stocks, particularly small cap tech stocks, just didn't get the memo.
This is just
small cap tech's been
way,
underperforming for over a year.
It's just another way of saying breadth is expanding. That's all.
Yeah, I mean, I suppose, yeah, I guess you could say it's not so much breadth expanding as it is sectors rotating. How about that?
But if more stocks are outperforming their index, then is that not the definition of breadth expansion?
No, I would argue it's more sector rotation than breadth expansion. We're rotating. Wow. Like, for example, last quarter, tech was down. Negative returns for large cap tech index. But discretionary financials and industrials were all up double digits. So that's not so much breadth expansion as it is rotation out of technology and into those other areas. You see what I mean? Like if technology would have been up double digits also, and all those others are up double digits. Now that to me is breadth expansion.
Fine.
Right? You feel me?
Yeah.
Not to split hairs here.
But,
you know,
I'm with you.
And by the way, to your point, Spencer, you can't have a real conversation about market breadth without also including sector rotation in that discussion.
Yeah.
Right? Like it's all part of the same conversation is what we're saying here. But why don't you throw up the seasonality? Because, September is supposed to be a bad month historically. Not supposed to be. September is a bad month historically, the worst month of the year. And stocks were up across the board. International ones, American ones, large ones, little, big ones, small ones, medium ones. So a lot of strength. And Goldman Sachs just came out and talking about the year-end rally, suggesting that the 6,000 target for the S&P 500 by year-end is probably a little light, right? Probably a little light. That ripper into year-end gets going in a couple of months. You know what they say, Spencer Israel? Buy in October and get yourself sober.
Yes.
Are we not in October?
Yeah, we are. It's probably about time when people should start revising for the last time their year-end price targets, because
Spencer, how are we supposed to buy the dip in October if there's no dip? Right? You buy the weakness into October. We haven't had any weakness.
What do you mean? You can buy the dip in tech. We just talked about that.
Fun fact, Spencer Israel, the NASDAQ 100, your tech index, just closed at an all-time high. And then technology.
No, large cap tech. Large cap tech.
Large cap tech came within 0.2% of a new all-time high.
Okay, then I don't know the answer to your question. Then what do you want from me?
Oh no, I don't know the answers either. No. It was a rhetorical question.
All right. Yeah. All right. I don't know.
It was a rhetorical question. You know.
All right. Can you explain this chart to me?
Which one?
The one that's up.
So here we're looking at a cycle composite. So we're taking every year since 1950. We are taking every election year since 1950, and then we're taking every fourth year of every decade. And we're creating an equally weighted composite. So you're taking the decennial cycle, you're taking the regular annual cycle, and you're taking the 4-year cycle, putting them all together into a cycle composite. This has been very helpful over the years. This is something we learned. I mean, a lot of people do this. This is something that I specifically learned from Ned Davis, one of my favorite all-time technicians. Big shout out to Ned Davis. This is something that they do a lot of great work over there. But this is something that was inspired by, our predecessors that have been doing this even longer than us. And we've been putting together this composite for years now. And boy, has it served us well. Kind of lays out the roadmap. And again, it's usually when the market ignores these seasonal tendencies that I want to, look out for. The fact that the market has done as well as it has, despite September being, historically very weak month, that stands out to me, Spencer.
Yeah. All right. I guess I don't really get why the blue line. I'm sorry. Why the composite is built the way it is in this chart. It seems somewhat random to me. Every year ending in 4.
This takes all the years since 1950. It takes every election year, so every fourth year since 1950, and it takes every fourth year of every decade for the decennial cycle, and it equally weights it. Which part doesn't make sense? What do you mean?
I guess the way it's laid out, so it's just another way of saying every year. I guess I don't really.
No, you're not listening, Spencer.
Okay.
Pay attention.
All right.
Every year since 1950 represents 1/3 of this composite. Every election year since 1950 represents 1/3 of this composite. And every fourth year of every decade for the decennial cycle represents 1/3 of this composite.
All right.
So when you add 1/3, 1/3, and 1/3,
you get one.
You get one, which is why there's one line. Feel me?
Okay. Yeah, I'm with you.
Does that make more sense?
This is like too much compositing this early in the morning for me, but I'm with you.
It's a good weight of the evidence, sort of, seasonal outlook, based on data, and then we'll see if the market respects it or ignores it.
All right.
Last month it ignored the weakness. That was impressive.
All right. We got any more? Shall I bring on
Mr. Glick,
the Warlock?
Bring him on. Bring him out. Bring him out.
All right. Let's bring Kenny on.
It's been a long time coming. They ain't come from my club, they tuck it. Putting up numbers, 99 pounds, and I still kept it 100. Hola. Yeah.
Mr. Glick in the house was good.
I gotta tell you, that opening gets me every time.
It really does. It really does. It really does. Like, we should all have copies of that and listen to that song as we walk into our office, like high-fiving, like the air,
Bro, I got a script that has that exact scene in it right there. So one of these days we got to redo the "Suck My Nasdaq" infomercial comedy bit that I wrote like 20 years ago.
Suck My Nasdaq. So Kenny, a couple decades ago, received a cease and desist from the Nasdaq because of his website suckmynasdaq.com. Right?
I still have the last hat. It's outlawed in 59 states.
Can you flip your camera around here? Just go to settings, because I want to be able to read that, but it's backwards.
Oh, wait, how do I do that?
Just go to that settings gear in the middle there.
Yeah.
And then click on video, and then it says mirror.
So take the mirror off.
There we go. That's it.
There we go.
All right. Now, what does it say? Show me the hat.
You fancy.
All right.
Well, the Nasdaq was not thrilled about this, hence the cease and desist.
Hey.
We received a cease and desist 2 weeks ago because of our young aristocrats. Can you believe that? Because S&P owns Dividend Aristocrats. They own like the trademark or whatever. So our young aristocrats, according to them, infringed, even though my lawyers were like, I don't think so. But we're not going to fight them.
When the NASDAQ finally found me, because it was a joke. I registered under a false name, my stage name, Jefferson Krull, at my parents' old address. So when they finally tracked me down and who realized who I was, they were pissed because they had to search for me for like 3 months. They didn't want to hear it. And I remember being on this conference call. It was like 8 lawyers and me. I'm like, what do you guys want from me? The website is just a joke. Here, have it. It was just, it was
just a joke. You don't like funny, haha? No, nothing.
Yeah. He's like, well, the joke would have been funny if you would have spelled the name a little bit differently. I'm like, all right.
If anybody in the chat wants to chime in on what we should call our young aristocrats, I was thinking about maybe the young tortilla flats. Maybe just no. Yeah. So any ideas on what we should call the young aristocrats? The Dividend Dukes was Josh Brown's suggestion.
I don't remember where we left it actually. As far as the name, there was a couple good ones in there, a couple bad ones in there too.
There's a lot of bad ones, but we'll come up with some good ones. Any ideas? So Kenny, you got the Dow down 150 points this morning. That's only 1/3%. I remember when 150 points used to be a lot. Remember those days, Kenny?
Yeah.
Good times.
Keep the conversation going that you were just talking about, how you need some sell-offs, you need some bearishness so you can buy the dip. You got it yesterday on Humana. Let me show you this chart, my friends.
Throw it up.
This is where we thrive. And again, this is why Liquid and Loving It is one of my nicknames, but I just like being the resident bear. You need stocks to get hammered down to 20-year lows to give you buying opportunities. And when those buying opportunities arise, you make a 30-point trade like Humana. And I've never traded this stock ever before. But when you see the same pattern show up, again, pattern recognition around VWAP and prior day VWAP. That's all this is. So when we came in yesterday, when I saw Humana, somebody said, hey, have you seen Humana? I'm like, ooh, look at that. Next thing you know, that's our focus. So when you see it breaking the VWAP in the pre-market, that was our first venture into it. And look how nice this trade was. This was 220 getting you up to 230. But again, a lot of people don't trade the pre-market because they want to trade options. So come into the regular session. Again, what you're looking at here, the blue line was yesterday's VWAP, and the orange line was the prior day. So let's imagine this was yesterday. So today's VWAP goes back to the prior day. And here's the faux and the show and the bro, fake out, shake out, breakout. So the better moves happen after they kick the last guy out, or they get the shorts convinced that it's going to roll over. They have to cover. The longs that want to buy the dip get excited. The money gets divided. Now they're broken. It's no joke. It's hard as hell to fight. Don't fight it. Freeze. Rock. Sorry. Every time, Keys. Every time. But look at this move, kids. So if yesterday was your first day with the Hit the Bid Room, you paid for your yearly subscription on this trade on 100 shares. That was awesome. So, going back to what you guys were talking about, you will have some dips to be bought, just like the Chinese stocks today. So you got the gap down today. You had the little blow off top in the pre-market session at 119.50 yesterday on Alibaba. And where did you sell off to? You sold off to prior day VWAP. So now that you're back below that price, we start looking at where it came a couple of days ago. So I just take a look at the data, and it's giving me a 3-day VWAP. We're below that, and we're headed down to the 4-day. So inevitably, 5 days worth of VWAP is where I live. So if you're looking to buy a dip on a stock that's trending down, just go back a couple more days and see if there's some support there, and then you look to strike. So I'm focusing on the Chinese stocks. So we had some good times with that so far. And again, a lot of different names on the radar today. Take a look at this one, Clove. Are you
dude? I saw that. I saw that yesterday.
Oh my!
I know.
I mean, yesterday was amazing.
CLOV.
Yeah, this is one of the awful SPACs coming out of I forgot what his name was, but
yeah,
this has been an awful stock. But when the awful stocks turn, this was a penny stock just 4 or 5 months ago, 60 cents up to 350. But you're over this 3-year VWAP. That has been the go-to trade over the last couple of years for me. These 3-year VWAP breaks, and all these red lines are when I traded the stock back in the day. I could just clear it out. Bang. And right now, again, if this consolidates above the 250, you got a brand new stock, because if stocks get, again, that 250 threshold, the $5 threshold, they're important. So what you get over that 250, you're probably going to be headed back to that 5. So I'm looking at this stock. I got this on my main watch list and some weird names. You guys remember EVgo?
Dude.
Hold on. I just wanted to mention before you move on.
Yeah.
Clove healthcare plan up 30% yesterday with Humana getting hammered. Another healthcare plan. So
Pin action,
you're
baby.
seeing massive dispersion there within the space on the same day.
Yeah. Yes. And apparently, again, I did a little research because, again, I thought this was just another worthless SPAC that was, catching a short squeeze. They actually turned their first profit, and that's what got this thing going again.
Bravo.
Again, there is something there. So again, I got that one on the main watch list now. But I'm sticking with the Chinese stocks. The Trump stock has been fantastic to trade over the last couple of days, and it's just been a great trading market. And back to the point, I hope October gets a little scary right before the earnings start coming in. Give us some more volatility, and then October 11th, I think it's October 12th, we start all over again with JP Morgan and Citibank and Wells Fargo, and the party begins.
That's right.
I love the fact that you brought up the Trump situation because finding support at those former levels, I thought it was a little bit of a stretch personally, so I did not participate, and I was wrong. Throw up slide 2. I thought participating was a little cute. Alfonso internally brought it up. Throw up slide 2, Spencer. The Trump SPAC finding support at the exact levels it found support last summer and throughout all of last year. I mean, again, I should have known better. I thought it was a little cute, and it was not, and it was an absolute monster. It's up 70%. And then here's something to keep in mind, something that I was thinking about philosophically. Let's say you think that this is a huge scam, right? And it probably is. So let's just assume that this is a huge scam. Now, if this is a huge scam, then aren't they definitely going to step in at that support and hold it up and make sure that it doesn't break support? Like, they're going to keep the scam going. That was sort of like my conspiracy theory behind the scenes. Like, if this is a real scam, it probably is.
Right.
Everybody knows they're going to hold support. They're going to step in and buy them. No?
Well, I didn't read too deep into that, but again, I believe this stock inevitably will go to zero. And what an awful symbol to choose, DJT. You know how hard it is to be delisted? You know how many terrible stocks there are out in the world? To get delisted is a special kind of awful. And he got delisted back in the day with the same symbol. To put it out with DJT just shows you I don't have the proper negative words for you to describe how I feel about that.
Yeah,
but
imagine getting your name getting delisted twice.
Yeah, yeah. That'll be one of his accomplishments. So when you go back and look at all the accomplishments, I've been delisted twice. Nobody could say that. Only the best. Only person to ever be delisted twice. Fantastic. Only I could do that.
Dude, your Trump impression is so good, but your Trump impression is like an impression of Alec Baldwin doing Trump.
Yeah, right.
It's actually Alec Baldwin and
right,
one of the late night guys. Yeah.
Kenny's impression is
that's good.
Alec Baldwin doing. That's hilarious.
All right,
yeah.
All right, Kenny, you're the man.
Hit the bit.com, guys. See you, Kenny.
All right, I'll see you guys in the room.
All right. That was good.
Right, that was hilarious. By the way, that Clove new 52-week highs yesterday, new 2-year highs. Really, if you want to get down to it.
You mentioned EVgo real quick. When I was in California, EVgo is charging stations, right? And they were beyond me. I couldn't figure out how to work it. ChargePoint, I figured out. EVgo was too complicated for me to figure out, apparently. So I don't know, but I thought that was funny. So you always like when you see stocks in the wild, right? So I was like, hey,
ADRs.
Okay, well, in my case, I was like, hey, EVgo, hey, ChargePoint, I know these guys.
Yeah.
Yeah, all right. Let's bring on today's guest.
You're like me. People make fun of me that I like to see stocks in the wild. Like, you're like me like that.
Sometimes, only if it's like a really beaten down stock from yesteryear, or a company that's not well known except on Wall Street. Right. Like no one knows Twilio. But if I saw Twilio in the wild, I'd say, hey, it's Twilio, right? But no one knows that company. No one's heard of that unless you're us. So we're in tech. But anyway, let's
like Kava. Like I have a Kava 40 minutes away. I asked Twitter if I should take the ride, and it was about split 50-50. Some people were like, hell yeah.
Yeah.
And other people were like, no, it's not that good.
Yeah. Yeah. All right, let's bring on today's guest, shall we?
Sure.
All right.
Yo, Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Hey,
wow, featured guest.
What's up, my man?
Look at me. Doing
Righty,
great, you guys.
Comes in here, one of my favorite technical analysts out there. Like Charlie Munger, closet technician.
You wish.
Let me tell a quick story. I'm walking down 6th Avenue with Righty. We're gonna go get some pizza. Right? We were going around to Lazara's, great spot over on 6th, 7th Avenue, 7th Avenue, I think, and like 30-something. Great pizza. And so I'm walking with Righty, and Righty's telling me about how fundamental oriented he is. How, I'm a fundamentals guy, JC. I'm doing all this stuff. And, but I really like allocating money in the S&P 500. It's such a great strategy. I'm like, oh, that thing that uses momentum and relative strength to buy more of the best ones and kick out the worst ones. You mean the greatest momentum technical strategy in the history of markets? Is that what you're describing to me, Righty? And you were like, Righty was like, motherfucker, he's right. I'm a technician.
Yeah, you cornered me in that one. There's some revisionist history in your telling of that story. I also had the small caps and mid caps and emerging markets. But yes, there's a relative truth to your story.
Listen, Righty, just embrace it, brother. We are welcoming you into our community. We have been welcoming fundamental guys and gals for many, many, many years. We're a good crew, Right. Technicians have more fun than fundamental analysts. Now that is a fact.
I was having a good time. I'm like, oh my God, with Kenny, I'm like, I gotta drink my coffee a little bit faster. I gotta up my generally Zen vibe. But I'll try and bring it right. A little more of a traders, chartist, thing. But
it's all good. It's all good. Listen, Righty comes to us from Chicago. Righty, why don't you introduce yourself to the folks? Why don't you tell them a little bit about, how you started out on the fundamental side, and then you met me, and we've been kind of transitioning.
Yeah, and then I had a conversion. Yeah, my dad was a financial planner, right? So
I didn't know that.
Oh yeah. 40 years at A.G. Edwards. And, so I saw that as a career path and yeah, he was a value guy. So, long-term investing value guy, reading The Intelligent Investor when I was really young and getting into that kind of stuff. Go to University of Wisconsin for an economics degree, right? So it's a blessing and a curse having an economics degree, right? It's a very inexact science and you can bend and twist things to your own liking. But yeah, so getting into the investing field, most people know me, the 20 years I had at Zacks Investment Research as editor-in-chief and in charge of Zacks.com. And their very fundamental focus on earnings estimates, but learning about timeliness, right? So no longer being just buying falling knives, right? To actually look for healthy growing companies, but prefer to buy them underpriced, right? So that's kind of my roots. And since then, I formed stocknews.com. That's how we got to know each other. My time there and still got a foot in that door and now doing some stuff with Wall Street Zen, a new partnership there.
And are you still, do you travel at all? Or you stick in Chicago?
Yeah, we're in Chicago, but we're also officially, as of last week, empty nesters. So we'll see where our daughters go and see where the wind blows us, for a second or third home. Yeah.
Well, congratulations. I got a long way to go before getting there, brother. I got a long way to go.
You do. Enjoy the ride, though. Don't ever ask for it to go faster. Just enjoy it.
No, I want it to slow down. Sometimes I look at my kids. I'm like, how are you getting so big so fast? Fathers tell you that, right? You hear that. Oh my God, it happens so fast. They grow so fast. Holy shit. Like it is real. It is not like, it's not a joke. I went away for like 4 days or 5 days a couple of weeks ago. I come back. I was like, Jesus, things change so fast. So Righty, we've been in a bull market for well over 2 years now. It is both under average, below average in terms of returns, and well below average in terms of duration. right? When you study every bull market in
No,
history,
there's more,
well
there's more
below
time
average
on
in
the clock,
returns,
for sure.
well below average in duration. So there is precedent, plenty of it, that would suggest that there is plenty of room to go, to the point where if the bull market doesn't extend longer, if the bull market doesn't bring in more returns, that would actually be unusual, right? Like, so let's just set the stage with kind of just that basic math and history. Where do you think we are in the cycle? Like, where are you looking at it before, do you think about the bigger picture first and then work your way into individual stocks?
Absolutely.
Or you do the opposite? Like, how do you think about that?
With the economics background, you got to start macro, you got to start big picture, and is the economy healthy? Because really the main reason which to have a bear market is the belief of a future recession, and seeing that in advance, and stock market goes down. And so without really seeing a recession on the horizon, it's kind of hard to be bearish. I mean, there could be pullbacks and corrections along the way, but the primary trend bullish, no doubt about it. The reason why you say that the returns of this bull market in the first 2 years are under the average is because the bear market was a false read, meaning that the typical bear market on average is a 34% decline, and we've seen 40, 50% over the, 34% is the average. This one got it to what, 26, 27%.
On the S&P 500?
So, S&P 500. And the Russell just a few ticks more. You never went as deep because it never actually became a recession, never had to go as low. And so therefore the bounce cannot be as strong, right? So that it's almost as if
that's
it
an
was
interesting
a
point.
head
So because
fake.
the bear market wasn't so bad, then the bounce isn't going to be as good. That's valid.
Yeah, and that's
Look
what
at you,
so this
Mr. Technical Analyst over here. Look at this guy. Come on.
You're gonna keep trying to corner me in that. I know you so
keep
well.
proving yourself a valid technician. So you continue, sir.
Yeah. So the chart that you showed 15 minutes ago with Spencer trying to show the 1/3, 1/3, 1/3 composite cycle. It's funny. I just wrote a commentary yesterday without that chart in hand, and I'm like, October flat, right? It's just been 5 months in a row, 5 months in a row going up. October flat because the election takes all the air out of the room. And then, no matter who wins, you always see an explosion on the election, and then you got a Santa Claus rally. So this chart perfectly says to me what I believe will happen at the end of this year, right? This is exactly where we're at. I'm going to say touching or getting very close to 6,000. But 2025 is going to be a lame duck year for the indices, because the valuations here, again, got to get back to my fundamental roots. The valuations for large caps, for mega caps for sure, are getting stretched. So I'm not saying bear market. I'm just saying it's kind of the pause that refreshes, right? That 2025 will be relatively flat for the indices, but probably gains broaden out. Small caps and mid caps are a better place to be. Other groups that didn't have time in the sun, okay, meaning other things than technology and AI, things that didn't have time in the sun, they now get a turn at bat. And that's what 2025 looks like.
Righty, we do a lot of sentiment work around here, and we try to aggregate sentiment at all. Is that incorporated in your process at all, market sentiment, or do you ignore that?
No, it's my sentiment. I mean,
fade your own sentiment when you get giddy.
How am I feeling, right? And sometimes it's a contrary indicator, right? So I call it the Steve Reitmeister nausea index, right? So if the market's going down, and right at the moment I'm thinking about selling, into it, the nausea kicks in, and I'm like, wait 2 days, and it will bounce, right? Boom. Right. And this is not talking about bear market. This is just a correction or a pullback in the midst of a bull market, right? Just staying with the primary trend. But no, the sentiment.
Staying with the primary trend. Did those words just come out of your mouth there, Righty? I heard that. Saying.
We're allowed to have some similar terms. We're allowed to have some common ground. Yes.
And I got to tell you, you're good at it, Righty. You're good at this.
Yeah. The fact is, the average bull market is 63 months, 5 years and 3 months, some longer, some shorter, right? And so what people don't seem to appreciate is how hard it is to create a bear market. So you just got to start with that, right? Because there's a lot of folks in our industry who just like to say things to be outrageous, to get noticed, and fear sells. Fear sells just as it does in the media for sports, for politics, whatever. So we have to have an honest basis of that 85-90% of our lives will be spent in bull markets, and that it takes serious energy in which to create a bear market, which on average lasts 13 months, right? So it's a 5-to-1 advantage in favor of bull markets. But it's not like the bear markets just slide in. No, it's a long bull. Here comes a recession. Here comes the economy getting soft, right? It doesn't have to be a depression, right? Just the economy gets soft. We pull back about a third, and then we get right back to the party, to the bull party. And so yeah, the primary trend is bullish, and all other things are kind of nonsense.
Righty, how about the fact that, you make a great point, 5-to-1, we spend most of our lives in bull markets, et cetera, et cetera. How about the fact that we just had 2 bear markets?
The COVID,
didn't we have the COVID, and then we had the next one, and didn't we just have those? So to expect another one seems like a stretch, no? So
here again, 2 years apart, right? And then the second one wasn't really, because it was a false read, right? So it's really a great one.
Some of these growth stocks, right? He got hammered, bro.
Yeah,
remember
right.
Everybody was getting.
You're an ARK Innovation.
I made a couple of phone calls about a SPAC. Everybody was getting one.
Yeah. So if, how can I say, there were 2 quarters of negative GDP growth. That is the first thing you need to call recession, right? So that's the very beginning of 2022.
Didn't we?
Huh?
You did get that, didn't you?
Yeah, exactly. So why wasn't it a recession if that's the main form? Because you also need unemployment to start rising. You need pain, right? You need it to result in pain. So why did the pain of unemployment not take place? And the answer is that during COVID, you had 2 to 4 million people, depending on estimates, decide on early retirement, that it was not worth keep going back to work, which created a void in the job market. And so the job market, there was jobs for anybody who wanted it. And so that is why, technically speaking, we were never in recession, and why the Fed was able to have such a long period of high rates without the usual outcome of creating a recession. It's a unique experience that will probably never happen again.
All right, so give us some thoughts on where your head is at in terms of sectors or industry groups that are on your radar. Are you just slinging Chinese internet stocks these days, or what do you got?
Yeah, no. Here again, going back to the macro, right? So what we're supposed to be doing in early years of a bull market, which is surprising that it hasn't happened, because it's been very tech focused, very mega cap focused. It's supposed to be economically sensitive stocks. It's supposed to be industrials. It's supposed to be the banks and finances, but also you got the lowering of rates. So who benefits from lower rates? Auto, right? Because auto loans become cheaper. Housing, buying new houses, home builders, consumer discretionary, cheaper to buy that, jet ski that you've always wanted.
I have always wanted a jet ski.
Yeah, why not? Right? Like Kenny Powers, right?
Oh yeah.
Yeah, hell yeah, right. So or gold, right? So gold's a very interesting story. I know you've been riding that horse here for a little while, talking
about an uptrend, righty. You tell me, bro. It looks like an uptrend to me.
Yeah, because right. So first you have the story of lower rates equals lower dollar. Lower dollar by translation equals higher gold prices. But now, coming into 2025, if the stock market goes flat, and if everyone's favorite stocks, the Magnificent Seven, just kind of lay there like locks, right, and don't really freaking do anything, then they're going to be looking, where's the next speculative fun thing to do? Oh, let's check out gold. It's rallying, and then everyone's hopping into gold, and you have a speculative. So even just on a fundamental basis, there's a story in gold. Now let's throw in that 2025 sucks for most stock pickers, right? Because they don't know what they're doing and they're just going to go, hey, isn't it time to buy NVIDIA? Why? Tesla, like that story is played out. Gold will be a very interesting story, especially if there's any increase in world crises. If Iran really jumps into the fray with Israel, boom, boom, boom. Yeah.
So you think that NVIDIA, that's it? Is no more NVIDIA?
Okay, sorry. Let me retract that. So I grouped the Magnificent Seven together. NVIDIA is the one that was most deserving of the rise in price because the earnings momentum is off the charts. It is for real. It defies, here again, the logical explanation that the world's supposed to be moving fast, that your competitors are supposed to be coming to get you, right? That you're not the only chip maker on the planet. Other people should be making chips that do well with AI. And so they've had this moat, economic moat around them for a while, just making money hand over fist. It's not meant to last, but as long as it does, as long as they're banging out these ridiculous earnings reports, then yes, the price is deserves. And once it's over, and once Intel, AMD, and whoever else, Micron, whoever else gets in and starts making a chip that other people want, watch it get cut in half.
You know, I thought it was interesting. They were talking about last night, I guess, Jared, what's his name? Wang, Jason Wang, Jensen Wang was on one of these TV channels talking about how this chip that everyone's talking about, this like super chip, is like right on pace and everything like that. And then everybody's like, you know, how is NVIDIA only up 1 or 2% on this like massive news? And like, I'm thinking to myself, well, by the time it's on basic cable television, right? Like this is not like, just because they're telling you it's breaking news doesn't mean it actually is. Like, they're probably just lying to you. Like, there's nothing breaking about this news. Yeah. Like, the market is already clearly has been pricing that in. You know, this television network's attempt at entertainment is just that. It's not breaking news of anything.
You're speaking my language. People who spend time thinking that they can watch the news and make money in the stock market, it's a fool's errand. It's a dog chasing its tail. It ain't going to get there.
Yeah. And then, so what would you suggest for investors out there in terms of like how to think about, you know, consuming, you know, staying quote up to date on what's happening? Like, you know, if you're not watching TV, you know, you're not looking at as many charts as we do. Like, what do you suggest?
So news, no. You know, opinion, right? People who do devour news in order to create an opinion and a worldview and a strategy. That's what we do. So that's a good use of time, right? To find a strategy that you're aligned with and go with that. But for me, as you know, like, you know, going back to the Zacks days, going back in 1999, I really enjoyed having a quantitative system, a stock rating system at my back. Okay, let the computers do the heavy work and lift and analysis on the stocks, trying to find those of true fundamental merit to narrow the universe, and then with this much smaller group of stocks that are pointed out as being more attractive, then me going in and doing my research, taking a look at the news, at the valuations, and just sometimes it's, you know, we've been doing this so long, there's a certain divining rod. This is the one, right? There's just something in our gut that says this is it, because it's just hit all the right buttons. So that's my process of doing things. So for the last couple of years, it's really been the power ratings over at Stock News, 118 different factors, analyzing the stock, narrowing it down from 5,300 stocks to consider to 250. And then doing my homework. That's how I like going about it. And then going in with the mindset of what sectors are going to be in better shape. As I said, auto, housing, banks, consumer discretionary, technology, sure, but as long as the valuations are legit, not going to be chasing them now.
So you just wouldn't buy any technology, even though valuation, you know, because of the valuation. When you look at this, do you look at the underperformance, the massive underperformance in large cap tech throughout 2024, the massive underperformance in small cap tech? Small cap tech is actually down 3% for the year. Large cap tech was down last quarter, for example, with great returns across the board. Like, do you think about that at all, or is the valuation more important?
So Spencer's like, hey, any chart you want to put on? And I was thinking about it. I didn't do it, but if there was one chart I was going to do, it's a valuation chart by market cap, right? So mega cap is like 35 PE, like nosebleed territory. Large caps 2022, that's fully valued. That's not overvalued. That's just kind of fully valued, and why I think we're going to create a pause. So yes, small and mid caps are around 15, 16. That is under the historical average. That is, that gap between the large caps and the small and mid caps is where they have to catch up. So you were so you were also talking about in what industries? Yeah. So almost across the industries, small and mid cap is where it's at. There's a lot of great, healthy, growing companies that are just a lot cheaper than their larger peers. That is where to go. So yeah, in any industry you want to go in, I would say please try and look at small and mid cap first. Yes, large cap, but more like the 20 to 50 billion, not above.
And what do you think about the small cap industrials have been leading this entire bull market? People talking about how small caps are not working. Maybe your small caps aren't working, but small cap industrials have been working. Small cap materials making new all-time highs. Small cap discretionary acting better. I mean, there's been space, like areas just not small cap tech. Regional banks and biotechs have been struggling too, which is a big part of small caps. But
if you look at the way that new bull market cycles are supposed to begin, it is supposed to be economically sensitive stocks. So the group that you just talked about, the like industrials and banks and materials, those are all the early winners. And yeah, people are going to look under a few more rocks to find them in the small and mid cap space, but that's what you're supposed to be. But really, when you look at the most of the charts, it was like, tech. And then, oh, by the way, these other groups are doing okay too.
Yeah, but remember, off the lows in the summer of 22, remember, tech didn't get going until 23. But the entire back half of 22, financials, industrials, consumer discretionary, were all leading. So they were, to your point, the early leaders, and then tech came.
Yeah, but and then just tech, mega cap tech.
Yeah, they were an outperformer. It wasn't just mega cap tech. There were a lot of other stuff. There were a lot of consumer discretionary. Airlines were ripping at the beginning of 2023. So I'm saying,
not
airlines, cruise lines.
As we speak, the S&P 500 is up 21% on the year, and the small caps are up 10%. Right.
And small cap tech is down.
So yeah. So what I'm saying is just by matter of degrees, it's been a large cap game, and particularly a mega cap game, right? So I'm one of those guys who's like no longer wants to talk about the S&P 500 if I can get away with it, because it's no longer a good. So love investing in it, as we know, as fellow momentum, players. But in terms of it being an accurate indication of what the average investor is getting, it's not. I believe that RSP, equal weighted S&P 500, is slightly better, but really it's kind of the average of that and the Russell. So if you took those two together,
which Russell?
Huh?
Which Russell?
2000.
Russell small cap.
So I'm saying is, what is the average investment? I mean, like if I want to compare myself, how am I doing? Right? If you look at versus the S&P 500, you feel like you suck, right? Like the majority of people.
Not the last 2 months, you haven't.
Yeah. But going back 2 years, it's been very much S&P led. So what I'm saying is that the RSP, equal weighted S&P 500, and the Russell 2000, I think, are much more accurate and honest descriptions of where the average investor is, the average mutual fund is at.
And what about the value line, geometric index, looking at the median stock? Would you put that in that category too, or not so much?
I haven't. That's an interesting one to consider, right? Because median, right, mathematically is that 50-yard line, right? I'd be very interested to know what that.
That's a lot more like the small caps than it does the equally weighted S&P 500. If you're wondering, what I like about the value line, they say it's a hipster index. There's only like a few people who follow it, but I look at it every day for decades now. Yeah. It's the median stock, but it's going to look a lot like the IWM. Yeah. It's not going to look, or at least it doesn't look like the RSP. By the way, the equally weighted S&P 500 RSP just closed at new all-time highs for the month. So did the market cap weighted S&P.
By the way, bringing up value, you brought me back. Remember, I mentioned that my father was a financial planner, right? And he teach me that. I'm talking about 13 years old, right? So 13 years old, being in his office, over the summer, right? He brings out that value line book. Remember how big when it was printed?
I don't remember, but I've heard. You're a little older than me.
You've heard, right? You've heard your grandparents telling stories about that.
Great.
Yeah. So I'm a little bit older. Okay. So yeah, that
you look good though, Righty. You're looking good, buddy.
Yeah. Thank you. And so I actually, as a teenager, had a subscription to Value Line.
I love that, by the way. I don't think I've ever met anybody who's had a subscription. We got to give the people what they want, Righty. I mean, that's one thing I've learned over the years. You got to give them what they want. They want a stock. Fourth quarter, what's the stock or the ETF? What do you got?
Yeah, I wanted to write it down because here, when you use quantitative systems as the starting point, you don't fall in love with the stocks as much because you can always replace them if they're not going well. But I wrote down a few. Right? So going with some of my themes, MHO, which is M&I Homes, right? Home builders, lower interest rates. Certainly, that's a trend to play, and they've done well up to this point.
In the right space.
EME is MCore. The explosion, the earnings momentum of this stock is ridiculous. It just keeps banging out earnings beats, earnings going higher, still lightly valued. If we're going to go gold, I just picked one the other day, Kinross Gold.
Oh, yeah.
KJC.
Yep.
And then I'm going to throw out one more. There are too many banks to buy. But if interest rates are going lower, loans will go higher. People will be more interested in borrowing. Regional banks is the place to play that. KRE is the ETF that rounds up the regional banks. Still one of the few groups that's way off its highs, right? Because all those scares with Silicon Valley Bank and everything, it still hasn't made it. Yeah, still hasn't made it back there. KRE is a good place to go.
Righty, I love it. I like some of these names. The MHO, looks like home builders, right? Obviously, this EME, what a horse this thing is. So you're looking at a $20 billion industrial engineering and construction.
Yep.
These names in general, this one's from Connecticut, but a lot of these end up being from the Midwest. These like engineering, construction, machinery, like just boring, old, just print money, line go up. Like, I love that. And for a guy like yourself, like that seems to be like very attractive, right? Illinois, Ohio.
The beauty of construction companies like that is that one statistic they give at earnings is, what does the backlog look like? Because they're not just building for the next quarter. They have a backlog of business that will take them out 2-3 years, right? So the backlog of business gives great visibility into future earnings and future likelihood of success. And then it's really about how well they operate on that and where the EPS comes out. So that's the beauty of EME. For as amazing as earnings have grown and the prices come up on the shares, it's the backlog of business that continues to grow that gives visibility that, hey, there's 2-3 more years of attractive runway on this stuff.
Righty, I appreciate you being here, my man. Good hanging out in Wrigley the other day. We'll do it again. We're definitely doing it again. That was awesome.
Thank you. All right, guys.
See you, Righty.
All right, Righty. Dude, that bratwurst at the Wrigley game.
Yeah.
I'm still thinking about it.
Wasn't it good?
It had the sesame bun, right? It had the sesame bun, and then the onions. You had the cooked sauteed onions on top, but like they weren't too oniony. Like you almost wanted more onions. Man, I had 4 of them. I felt so disgusted with myself. I'm down like 10 pounds since Chicago.
Good for you, man.
That bratwurst just got, I was just so disgusted with myself. I said, this is enough, JC. Enough.
I hear you.
4 of them. I wasn't even hungry.
Dude, I know.
Righty. Closet technician, Righty. I love breaking his balls about it because like he doesn't want to be a technician so badly, but like he keeps coming back to trend identification and relative strength and his top-down perspective. I mean, sounds like a technician to me, bro.
Yeah, I think people have different definitions of technician. Like some people.
Whose definition do you trust the most?
I'm saying most people think chart patterns. Like that's what like they associate technical analysis with is chart
People
patterns.
should come hang out with us more, and they'll understand.
They should. And I've said this before, and I'll say it again. That's probably the biggest thing I've learned since working with you is there is a monumental gap between like institutional level CMT quality technical analysis that you guys do and like off the rack technical analysis, which is like the stuff you find on Twitter with like 15 indicators on your charts, and there's a head and shoulders here and a rising wedge there and whatever, and it's like that's like kind of like voodoo, right? But what you guys do is certainly not, right? It's a lot deeper than that. So
well, I appreciate that, Spencer.
Yeah.
I appreciate that, my man.
Righty
coming in hot, bringing in some good names. Kenny coming in, bringing in some good names. I mean, this is I like. I don't know. Good mojo.
I don't know if Kenny gave some good names. They definitely.
I mean, that Clove, that CLOV, making new 52-week highs, $1 billion healthcare plan. Yeah, that's on my radar.
I mean, EVgo, which is down to 500 million now, is up 32% this morning. What else is up a lot today? I mean, a lot of things are up. But what is the deal with this AMTD Digital? HKD is the ticker. It's $1 billion company. I don't really know what they do, but it's up 33% this morning. I don't know what's going on there.
Wow, look at this thing. HKD. This is AMTD Digital.
I don't know what this is. I usually have an idea for why stock is, if it's going to be up that much.
HKD is a French software company from Parets, $1 billion software from Paris.
And
I didn't know they had software companies in Paris. This is the first, as somebody who does this every day for many, many, many years, looks at a lot of companies over many years, not once ever, and maybe I'm just ignorant, you guys can school me, never seen a software stock from Paris or a tech stock in general from Paris.
Well, look, these things move. Like
Dawson's saying it's a China turd. Is it?
Oh, that could be it. I honestly, I don't know. I don't know, but if I had to take a wild guess, I would say maybe the HK stands for Hong Kong. I don't know.
Oh yeah, maybe hospitality and VIP services in Asia. There
okay,
you go.
Well, there you go.
There we go.
You gotta either like give yourself room on these names, because when they go, they go. But when it comes off, it comes off. I mean, Joby Aviation, which was up huge yesterday, is down 8% in the first 10 minutes of the day here this morning. So you know, these are wild children. So just be mindful of that. Hims and Hers down 12%, all because the FDA says that there is no longer a shortage of weight loss drugs. Eli Lilly, I guess, was able to produce a lot more, and so we're all good from a drug shortage standpoint. So Hims and Hers is getting cracked on that news. Levi Strauss is down on their earnings report, down 9%. What else do we have this morning?
We got the Dow down 240 points, NASDAQ down 0.25%, S&P down 1/3%, 30-year bond futures down 0.25%, crude oil up almost 3%, copper down 2.5%, gold flat, silver flat, VIX at 20. I mean, there's things moving. Bitcoin back down to 60, down 600 points on the day. There's things moving.
Moving. Mostly red so far. Nvidia, look at Nvidia. I think that might be all because Jensen gave an interview last night on CNBC, and he said that demand for the Blackwell is I think the word was insane. So that's the word that he used on TV.
Before we bring in Sean, I did want to give a little bit of advice. This is just my experience, and I don't give a lot of advice around here, but this is good advice, right? So if you got a pen and paper, write this down. You ready?
Yeah, right. Sure.
When you're in Paris, you eat at the Japanese restaurants. When you're in Japan, you eat at the French restaurants. That, my friends, is good advice.
What? I don't understand this.
When you're,
I don't know. Okay.
The best cuisine in the world on planet Earth, the best chefs are the French ones and the Japanese ones, right? They learn from each other. This is the best in the world, right? So when you're in one country, you go to the other's restaurant, because now you're going to a Japanese restaurant in Paris, influenced by the French. And then when you're in Kyoto or in in Tokyo or whatever, find it, go to a good French restaurant, and you're going to get that French food that's influenced by the Japanese. I'm just telling you, in my experience, it's fantastic.
Okay.
Listen, when you're in Japan, go to the Japanese restaurants too. When you're in France, go to the French restaurants. Don't get me wrong. Just make it a point to go to the other one. That's all I'm saying. Good advice. Don't eat 4 bratwursts at Wrigley.
Yeah.
That's another piece of good advice, right? Don't do it. No matter how good they are. Don't do it. Should we bring in Shawnee?
Sean is not in yet.
Where's Sean?
I don't know. I don't know where Sean's at. I think
we had some good conversations yesterday. Yesterday was not only did we have our monthly charts strategy session, not only did we have our momentum lab or momentum, our first mastermind. We got our labs tomorrow on Monday. We also had our team meeting, and there was a lot of important things discussed in that team meeting. I like where Sean's head was at. I always like Sean's perspective because while we come to the market from a trend identification standpoint, a top-down perspective, Sean approaches it from a volatility standpoint.
Yeah.
And it's not that he's not including those other things, and it's not that we don't include implied volatility and stuff like that. We do it in a different order. We start with the stocks and then bring in that implied volatility. Sean starts with the implied volatility and then brings in, right? I really appreciate that from him. So
let's find out what he thinks.
Shall we?
Yeah.
Johnny,
Good morning, boys.
Hey.
Did I do Chicago right, eating 4 bratwursts?
I mean, I don't know what you're complaining about. I mean, they were delicious, and that's what you do when you're in Chicago.
Oh, they were so good, man. They were so good.
I love that you said. I love that you said you ate so many bratwursts, but you weren't even hungry.
I wasn't even hungry.
Yeah.
Like I was hungry for like the first one.
They were there. They were there.
They were there. They were so good, and then they ran out of onions, and then the guy went downstairs.
Had one. Let it be known I only had one, but damn, it was good.
So I'm still thinking about it. Thinking about it. And you know what else I'm thinking about, Spencer? Remember when you and I were in Baltimore a few months ago, and we went to the Hood, and we went to that Korean barbecue place? Like we thought we were gonna get shot outside. Remember?
Yeah. That
I was thinking about that pork.
That pork. Yeah. Goddamn. This is good stuff. Anyway, enough of this. Sean, what's doing?
What's up, Sean, baby?
I see I have a fan in Buffalo, Bocce Pizza. Fun fact, I did work at Bocce Pizza. It's the best pizza joint in Buffalo, New York, for the record. I was never a delivery guy, though, so you got me confused with somebody else. I made a lot of chicken wings there, mostly chicken wings. I slung pizza a little bit, but yeah, spent 5 years.
Sean worked at a pizza place and wings. I worked at a hot dog joint, Our Betters, on 87th and Bird Road. Shout out 305. Anybody? I was the greatest employee in the history of Our Betters.
You were the greatest employee?
Fact.
Okay.
I designed a drive-through, a franchising process, the whole thing. They ignored me completely.
How many hot dogs did you eat on a typical shift?
You know what I would do? I was putting on weight because I was playing, Division I baseball, and I was going from high school to baseball, and I was super light. I was like 160 pounds, so I had to put on weight. Dude, I would go to the Pollo Tropical across the street and get rice, and then I would get the chili and make like rice with chili. So I would do that more than the dogs themselves. But I had what was called a JC dog, and the JC dog was chili and cheese with onions. But before you put the chili and cheese, you put a little ketchup there at the bottom, just a little bit, give it a little hint of sweet. That was the JC dog.
This is gross. I don't want to listen to
it was pretty disgusting. Anyway, I made a mean chili cheese fry. Sean, from an implied volatility standpoint, how are you approaching this market with the VIX at 20? When you wake up in the morning, what are you trying to do?
Well, we were talking yesterday in our internal meeting about, there's still a lot of great bullish setups popping up all over the place, right? So we're still in we want to be aggressive mode. However, I came into the meeting yesterday saying we do have a little bit of a window here right now. I feel like that this is a good opportunity while we have it to put on some delta neutral options credit spreads, because we do have a situation here where volatility has spiked. I don't want to use the word spiked. Relative to what we saw in August, this is nothing, right? Of course, but that was an anomaly. But generally speaking, when you see VIX, above 20, approaching 25, generally speaking, that's a good time to be selling premium. Now, I don't recommend necessarily we go out there and sell naked premium. In fact, I came to the table with some ideas, some iron condors, which are defined risk credit spreads, so that if the market does explode here in either direction, I'm not going to get hurt too bad. But this is a good, this is a little window. It might not last for much longer, right? Like yesterday was a good day to do it. Today continues to be a good day to do it. Maybe for the rest of this week, it's a good time to sell premium, and we'll see what it looks like next week. But I'm saying all that because I haven't changed my frame of mind that I'm still looking for bullish opportunities. Though, if a good setup is out there, I want it. I want to participate. But right now, while the getting is good, it feels like we should be putting on some credit spreads.
Yeah, I'm with you there. We want to get paid when the market is allowing us to get paid. In other words, if these buyers of options are frantically trying to buy options at a faster rate than they have in quite some time, shouldn't we just give the people what they want and sell it to them at elevated prices?
Well, we love to say around here, the old Wall Street saying that when the ducks are quacking, you got to feed them, right? So that's what we're doing. That's what we did. And, it serves us well usually. Right. It serves us well usually and often, but not every time, of course. We've certainly and look, I feel like right now, if I'm wrong on my delta neutral credit spreads, I'm probably going to be wrong because this bull market is just going to resume higher. And I'm okay with that because I've got a lot of long exposure.
So correct me if I'm wrong, because when we have these conversations and Sean's like, oh, we want to put on some delta neutral trades. We want to sell some premium, strangle, iron condor. Just let's collect income while the opportunity is in front of us to go ahead and do that and collect income. What I think is let's find the messiest chart we could find. Like just a hot mess that is probably not going to go higher or lower. It's just going to continue to be a hot mess. That's how I think. Do you think that's the right way to look at it, or is that too?
No, that's exactly the way you want to look at it. You want to look at stocks or ETFs that are stuck in ranges, right? Because the ranges define the trade for you. Because if you're putting on, let's say, a short strangle, which is where you sell an out of the money call and an out of the money put, right? That's just a real basic credit spread. When you do that, you want the underlying to stay in that range. If it starts, breaking out of the range to the upside or breaking out of the range to the downside, then the trade you have on is the wrong trade. We are betting on range-bound consolidation. And if the market is proving to us that we're wrong, we want to get out. So that said, we're looking for instruments that have clearly defined upper bounds and lower bounds. Ideally, right? We don't always get that, JC, you know that, but ideally, when we're looking for the perfect setup, that's what we want. And, we put a couple trades on yesterday that have that, and we'll keep looking for more like that.
How about like expediters? Is that liquid enough?
Was that EXPD?
Yes. This is failing up at resistance. So, you could probably sell the 131s, sell the 111s maybe. Maybe that's too far.
Let's see. Yeah, it is liquid enough. Actually, yeah, tricky. It's tricky. It's a $570 stock.
No, it's not.
EXPD? Oh, I'm sorry. I'm looking at. You caught me off guard. I don't have my setup here, so I'm scrambling. Okay, it's $120 stock. I mean, I'm looking at the November options right now, and the at the money calls, for example, are currently bid 370, offered 510. So that tells me it's not very liquid. It's early still, but
$17 billion tranny.
Yeah.
But I'm looking at these messy names, and seeing if
yeah, look,
I'm with you.
Rule of thumb when we're looking for iron condor or short strangle trades is we want to, if we're doing an iron condor, it's kind of, we can do whatever we want, right? Because we're defining our risks. So I'm much more comfortable doing stocks, but generally speaking, I want to do a large cap stock, a big cap stock, because they tend to not have the crazy gap moves. if it's earnings, yes, they might have a big gap. And of course, we're going to avoid earnings for an iron condor type trade. But generally speaking, with stocks, I want to do an iron condor, which defines my risk.
What about Microsoft?
Microsoft would be a great candidate.
We could sell the 400s and we could sell the 470s.
Let's see.
So we'd probably sell the 440s, right?
Yeah, I would want to, without looking at the options prices, I'd probably want to sell that 445 strike on the upside. Yep. And
400 on the downside.
Yeah, 400 probably would work. Maybe 390, but 400 if you want to be more aggressive.
So what we're talking about here is very simple. We're essentially, with volatility elevated where it is, we're getting paid to be options sellers. If you're an options buyer, you're paying a ton of money, right? So it definitely pays historically to be a seller here. So we're looking specifically for a messy market. Microsoft is a good example of that. Expeditors is, but Microsoft's options market is a lot more liquid than Expeditors for obvious reasons. So what Sean likes to do is to sell a strangle. So you're selling an out-of-the-money call. In other words, a price that's above the stock, right? Of the price of the stock, we sell that, and then we sell an out-of-the-money put. So in this case, 400 in the case of Microsoft. Now, Sean's rule of thumb, generally speaking, is that when it comes to individual stocks, there's a lot of risk if you're just naked short one call option and naked short a put option. There's an unlimited amount of risk. Now, if it's an ETF that you have a basket in that portfolio, you are strongly minimizing that risk. Theoretically, you still have unlimited risk, but because it's not just one stock, it's a basket of stocks, that risk is lowered. Individual stocks, anything can happen. So what Sean likes to do is to hedge those calls and puts that have been sold, is to buy a further out of the money call and buy a further out of the money put. So now you don't have that naked exposure. You don't have that unlimited risk. You've actually now defined your risk. You're going to accept less money because you have to take some of that to hedge yourself. So you're going to make less, but you're going to be able to sleep at night better. How did I do, Sean?
You did great. And the one thing I will add to all of that is that whether it's a strangle or an iron condor trade, we put these trades on not because we're looking to hit a home run. We put them on because they have a high probability of success. And all by itself, if you put the trade on and hold it to expiration, you do have a high probability of success. But one way we can actually improve our possibility of success is to be aggressive in taking profits. We don't ride it to expiration. We take a profit at some point along the way. We're not greedy. Generally, I like to buy the spread back when I could buy it back for half of what I collected on day one. So just throwing numbers out there, if I sold a straddle today for $3, I would look to buy it back a week or so later for $1.50 and book that $1.50 gain. It's a smaller gain, but again, even higher probability. And that's the key when we're putting these types of trades on. We're looking for a win. We're not looking for a big win. We're just looking for a win. And the odds are in our favor. We'll get
big enough where you can put in, just do a strangle, or you'd want to hedge that out with an iron condor?
I would probably still prefer an iron condor. Yeah, I mean, Microsoft is one of those names that I would be more comfortable selling naked puts, but I would not be comfortable selling naked calls. I don't like to sell naked calls at individual stocks. Just blanket any stock. Because there is literally unlimited upside.
If you ever have some time, walk around the city of Chicago specifically, more so than New York, and go talk to traders. The older, the better, right? And go ask them about their experiences selling naked calls. Walk around, go to Sirius, go to different bars, and just be like, "Excuse me, sir, I'm getting into the game." And JC Parets said to come and ask folks like you about your experiences selling naked calls. Would you mind sharing a few stories about whether that worked out well for you or whether you regretted those decisions? And they will go on and on and on and on about just how dumb that was. Right?
That's a wonderful segue, because while we were in Chicago, I had the good fortune of meeting an old school futures trader for the first time. He came to our happy hour, and great guy. I invited him to be on the Off the Charts podcast. We actually just recorded yesterday. It's not going to be out for a couple of weeks, but to your point, he's got stories exactly like what you're talking about. And it was such a great conversation. I can't wait to share this with you guys in a couple of weeks. So stay tuned for that. We've got a great stable of Off the Charts interviews coming up for you guys. Really pumped.
Love it. I gotta go to recess, shall we, Spencer?
Yeah, I was gonna say the selling naked calls probably worked great until it didn't work great. Right?
That's the common lament for option sellers.
Yeah, that's usually how it works. Like with the bad ideas work good. They seem like good ideas, but then they don't work, and then they're terrible ideas. So okay, recess.
Not to mention, just as a human, when you're just like, this thing can't go up anymore, you just want to sell naked calls so badly. So it's an emotional thing as well. So keep that in mind. All right. So I just wanted to bring up, I saw Duff's was being talked about in the chat. My favorite website, other than peopleofwalmart.com, is goldbelly.com. Second favorite website. Throw up slide 2 there. The real star of the show. Of all my Gold Belly orders, so this allows you to order from all over the country, various restaurants. I highly encourage you. You're going to pay a premium, but that's okay, as far as I'm concerned. Well worth it.
Jewish holidays tab. What? I like the Jewish holidays tab. That's good.
It's fantastic, right? I'm telling you, these guys are great. The bagels from Essa Bagels, holy shit! You forget just how good these bagels are.
Essa bagels are good.
Where I live. Let me tell you something. Duff's wings. I've done the Duff's and I've done what the Anchor Bar. Anchor Bar sends wings also. I've ordered both at the same time and done the test. For me, and Sean, you're the Buffalonian. For me, Duff's is the one we want. Duff's hot wings. Order them on Goldbelly. Great website.
So, look, I grew up very close to Duff's. I could ride my bike to it, and I did that often when I lived there. Duff's wings are great. Not my favorite from Buffalo. I'm a homer. We talked about Bocce Club Pizza earlier, where I worked. I think they have the best wings. Again, I'm talking my book because I worked there and I made those wings. But here's the thing about Buffalo wings, JC. I'm glad that you're ordering them on Goldbelly and you're enjoying them. That is fantastic.
I very much am.
More people should do that. But your experience with Duff's wings will transcend your already high opinion of that if and when you and I actually go to Duff's and eat the wings fresh from the fryer.
That's when you have to go to Buffalo. Who wants to do that?
Well, when we're going to a Dolphins-Bills playoff game in late January, we'll be there and we'll have a great time.
Buffalo in late January is lovely that time of year.
Lovely time of year. It's a lovely time of year. There's no such thing, hey, JC, there's no such thing as bad weather, only bad clothing. So we can work it out.
Is that what they say in Buffalo, Sean?
Yeah, that's what they say in Buffalo.
That's what they say everywhere.
Okay.
Like the people stuck in space, they're like, oh, this is like amazing. This is my favorite place. No, it's not, bro. You thought you were going to be there for a week. You're there for 10 months. Like, that's not great. You're just telling yourself that.
Oh, God. Yeah. All right.
Like when I'm eating cauliflower. Oh, this cauliflower is so good. No, it fucking sucks. It's terrible. It's cauliflower,
All right, well, look, for my recess, I just want to shout out Yosemite National Park. I was there last week with my family. First time ever. And it was lovely. Great place. But I have to say, maybe I'm a little spoiled. I live here in Colorado. But when we were walking around Yosemite, my whole family, we were all kind of like, it's like Colorado. Not much different. So if you've never been to a national park and Yosemite is your first one, you will absolutely love it. It is amazing. But if you've been to a lot of national parks like we have, or if you live in a place like Colorado, there might be better places for you to go. And if for no other reason than it's a little crowded. There's a lot of people. I don't like people when I go out in nature. I want to enjoy it quiet. That's my thing. Yosemite, it's a valley and there's a lot of traffic in it. There's cars driving back and forth. You hear the noise. Not my favorite, but that said, great time. I'm glad I checked that off the bucket list. I've seen it. It was wonderful. If you're not out there visiting our national parks, you should do that.
Sean, Colorado is the California mountains on steroids. When I lived in California, I remember I was skiing in Colorado with probably Brian Shannon, having a great time in Colorado. And then a week later, I was in Lake Tahoe. and it was like a joke. It was like, oh my God, look how cute these little mountains are, right? Like Colorado is so massive and so big. I think you're understating exactly just a dramatic degree of difference between mountains in California and real mountains in Colorado. It is something. So
I see someone
Colorado.
I see someone in the chat is mentioning backcountry. That's something I definitely want to check out in Yosemite. We didn't have enough time to do all the stuff we wanted to do. It's a very large park, one thing I learned, which I was surprised by, is Yosemite is a very large national park, but the valley is where most people go. That's where all the famous stuff is. The valley is actually a very small part of the Yosemite National Park. So yes, if I had more time and more supplies, I would definitely like to go deeper into the park and see the stuff that's off the beaten path. And maybe I would change my mind about it. In fact, I probably would change my mind on it. But at least I saw the tourist stuff that all the tourists go to. And I was like, it's wonderful, but didn't change my life.
Spencer, how was your Rosh Hashanah?
It was good. We had some pretty brutal traffic last night, but we made it. It was all good. Had some delicious brisket. Brisket is like one of the go-tos for the Jewish holidays for most people, I think. And we'll have more tonight. I'm hosting. I'm still at the point in my life where hosting is a novelty. I've only hosted like twice prior to this, so it's still new and exciting tonight.
What are you making?
What?
What are you making?
We're gonna have actually a lot of the same foods as last night: chicken, brisket. I was in charge we were in charge of making the sides, so we're doing some shit. What are we doing? Sweet potatoes. Damn it! What are we doing? What are we making tonight? Quinoa salad. I forget.
You're not the one making it.
Quinoa salad, sweet potatoes, something else. Oh my goodness. Oh yeah, cauliflower.
Shout out, Mrs. Israel.
Yeah, that's right.
I was invited to a Rosh Hashanah dinner once, and I enjoyed it. It was fun.
It's great. It's just a meal. There's no. It's not in Passover. There's no service. There's no nothing. It's just a meal.
Wait, isn't this the one where like you guys read from a book and you go around the table? That's the one I went to.
That's not this one. This is this is just dinner. This is just a meal.
By the way, if you're Jewish out there, the life hack for the Jews: find yourself a Cuban family and get invited to their Christmas Eve. That's how to do it. In Miami, they do it right. Like, it's easier to do in Miami because you got a lot of Jews and you got a lot of Cubans. Dude, the Jews that come to the Noche Buena, they're the pros. They're my heroes. They know.
Noche Buena. I love the sound of that.
Yeah, it's fantastic.
All right,
guys, let's roll.
All right, let's get out of here. Sean's got the jam session at noon. We got chart request live at 1. We'll see you guys there. Smash the like. Thanks, Righty. Thanks, Sean. Go make some money. Hey, follow us on the socials. We'd appreciate that. Have a good one, all right?
Adios.
Yep.
I can't take no loss. I don't even know what it costs.